Wonderful. Good evening and welcome to ECS 3703. This is International Finance Day. And today in particular, we are looking at the balance of payment. So the balance of payments, I think we had a brief introduction last week, if I do remember. And I already sent some notes in the group for us to go through. So we are basically going to be doing our session based on the notes. So we are looking at the balance of payments in the South African context now. I think if you check that in the textbook, what you get there is the balance of payments from the United States of America. So we are going to be doing it in the South African context. So I'm just going to share and we get started. So in as far as our examinations are concerned, we don't really get many questions from the balance of payments, but the major question that could arise here, it could carry a lot of marks, but it's a simple question. They could just say, describe the South African balance of payments. So what you're basically going to be doing is what we are doing tonight, going through all the elements that you find in the balance of payments in our South African context, right? So if you want to see how this one particularly differs with the one that's in the US, just juxtapose these notes with what you get in the text, then you will see the difference there. But our focus here is the South African context. All right, and I promised again that from around next month, I'm going to be providing us with short notes, short videos with short videos concerning these little topics. So I'm going to do that. I'm hoping that those videos are going to shed more clarity, but really there isn't anything complicated to this except that we understand the definitions and what we expect to find in the different, or what constitutes the different elements that you find in the balance of payments in that statement. So I actually put up an example here. This is an example that I got from the internet. I think this one moves right through up until 2021. So this is the example that we have. And then I think your study guide also has another example, so you can look that up as well. All right, but just to grab a start here, what is the balance of payments? What are we talking about when we talk about the balance of payments? So this is basically a summary of all trade in physical goods and services and the financial assets and liabilities between a country and its trading partners over a defined or specified period. So the defined period under most circumstances is going to be a year, right? It's mostly going to be a year. And then the other definition there, the balance of payments is an accounting statement of the various transactions that have taken place. Let me just blow this up so you can also see that have taken place between a country and its trading partners over a specific period, which is usually a year. So such transactions are normally aggregated according to the type of exchanges that have taken place. For example, whether they represent trade in goods, services, or an exchange of financial assets. So we are going to see that there when we are now dealing with the different components of this balance of payment statements, the different elements that we find there. So whenever you are asked to describe the balance of payments, I think it's always good to start off with the definition. First, tell us what the balance of payments is. Maybe you might want to differentiate, like I did here on this note. You might want to differentiate it from the national balance sheet, just to let us know that you have an understanding of how that differs from the national balance sheet. So the major difference is the national balance sheet basically gives us a statement of the country's assets and liabilities. So if you have done accounting before, you will appreciate that a balance sheet definitely is a statement that shows you the assets and liabilities as at a certain date, right? But whereas, remember, with the balance of payments, we're looking at this in terms of sort of over a period, which is over a year, right? So which should then remind you that the balance of payments is a flow, while the balance sheet is a stock variable. So one is a flow variable and the other is a stock variable. So stock variable, because it's going to give us the actual value of the goods as at a certain date. And then a flow variable for the balance of payments, because we're looking at the flow of goods over, for example, the flow of goods. If we're going to be looking at, say, the first part, right, we'll be looking at the flow of goods, between countries over a period of a year. So, but you must appreciate also that there's a link, of course, between a stock variable and a flow variable in this context. So a flow variable is obviously going to contribute to the stock variable at the end of the day, right? But I think all that you will get on these notes there. All right, so this is the example, and then we're going to start off by breaking this down now, the current account, and then we'll talk about the capital. Let me blow it up again. So we'll start off with the current account, and then we'll look at the capital account, the capital transfer account, and then we'll look at the financial account, and then we'll look at the unrecorded transaction. So whenever you are asked again I'm going to repeat this, whenever you are going to be asked to describe the South African balance of payments, we are basically going to be breaking this down the way we broke it down on these notes, describing each and every one of those elements, one at a time. All right, so let's start off with the current account. So this is what you basically find at the top of that statement there. All right, so you therefore need to know what constitutes a current account, the sort of things that you expect to find in a current account. Same with those other accounts, with the little accounts that we're going to be looking at. So you need to be talking about what sort of things we are going to be finding there. So the current account is subdivided into the trade account, the net service receipts, net income receipts, and the current transfers. So once you've identified that it can be subdivided into those elements, then you simply need to describe them. What do each and every one of those subdivisions record? What is recorded there? So the trade account, we are dealing with physical goods here, right? We are practically dealing with physical goods. So the trade balance is shown. Okay, so in the South African balance of payments, we don't really have the trade balance shown, but you can easily do that calculation there. So because we are looking at physical goods, then on the first part there on the top, we are looking at the merchandise exports free on board, and then right on item number 1, 2, 3, 4, 5. On item number 5, you have less merchandise imports, which is free on board. So if you deduct those two amounts there, you are going to get the balance on the trade account. So you'll be able to tell if we have a trade deficit or a trade surplus, right? That's right, that's there. So that's what we mean when we say in the South African context, you don't get that shown explicitly, but you can just do the calculation for yourself to see what it is there. So the trade balance, okay, it can be easily calculated by subtracting the value of merchandise inputs from merchandise exports and net gold exports. So that will basically give you that amount there. All right, then note again that because of South Africa's historical dependence on gold exports, net gold exports are recorded as a separate item directly below the merchandise exports. So we know that historically we've actually gone quite big on gold. Joburg is actually a city of gold, right? It's a city that's been built on gold. So because of how important gold is, that's why you'll find it there disclosed or displayed separately, right? We're having a discussion, I think, yesterday with the other class. I think we're doing international trade, and we're talking about a certain time when South Africa was under sanctions. So though it was under sanctions, you realize that the exports of gold were not really affected that much. That's how big we are on gold, right? So your starting point on the current account is to talk about the trade account, so which is just about the physical goods there, right? the export and the import of physical goods. All right. And then then we also have service and incomes, right? Let me just take you there and you see what we are talking about there, right? Where we have the service receipts, that's item number 3. And then right below there, we have the less payments for services, right? Less payments for services there. That's what we are referring to there. So the main service items are transport for goods and passengers between countries, freight and merchandise insurance, other financial services, and various business, professional and technical services, government services, and foreign travels. So just go through this. So a good example of this is like myself. My profession is to conduct tutorials and lectures, right? So if I'm going to be lecturing, in fact, let me give the example that I gave yesterday. So if you're going to be an English teacher and you're going to be tutoring students that are in China, so what you're doing is going to be classified under that there, right? That's classified under a service. So it's a service that you're going to be giving. So if they're going to be paying you money, then that's going to be a service receipt. But if you are going to be taking tutorials from somebody who's out of the country, then it's going to be a payment. So that's going to be recorded under that there, right? When we talk about other financial services, you find that maybe you could be running, say, a CPA company, or let's just say an accounting firm, right? And then, like the one lady that I used to know some years back, she was into insurance and she was doing books for insurance companies. So she had clients out of the country. So I used to assist her with doing books for some clients that she had, but close by here in Swaziland. So when they make those payments should be classified under that there. All right. And then when we talk again of incomes, right? So services, we have service receipts, and then we also have service payments, and then we also have here incomes, right? Income receipts just below service receipts, and then you'll also have income payments right down there. So what we talk about there, the main income items are interest and dividends and foreign branch profit. So if you have certain people that have invested, or certain companies, certain entities that have invested here, say they bought shares on the JSE, or perhaps they bought shares in your company. So at the end of the day, you might want to pay them dividends. Sometimes they might even be getting a share of your profits, right? So when you make those payments are going to be classified, they are going to be recorded under the current account, right? They are going to be recorded under the current account. So right below there on those notes, there's an explanation. There's an explanation as to why that shouldn't be recorded under the financial account, even though it pretty much seems like it's a financial item, but those particularly need to be recorded under the current account. All right. So I think that's going to be clarified just now when we go to the financial account and you see the sort of things that need to be recorded there on the financial account. All right. So let me see if there's anything of interest that I'm leaving out, but the rest of everything there.
After 80 meters, turn right, then take the second left.
Bongani? Oh, okay.
Can you hear me?
Yes, I can hear you.
Right.
I think there's
then take the second left.
A noise.
Can you hear me?
Yes, I can hear you.
Can you hear me?
Yes, but there's a GPS. Okay. Yes, I can hear you.
Okay.
Please just turn down the GPS. Yes, go ahead. Hello? Oh, okay. All right.
Okay,
now,
I'm saying I'm listening. don't want to disrupt this.
Oh, okay.
Because if there's something
200 meters,
All right, no problem. Okay, sorry about that. All right, so we're just saying the main income items that you find there are the interest, the dividends, and the foreign branch profit. So these can go either way. So if you're going to be receiving them, of course, from if you here in South Africa have made an investment abroad and you're going to be receiving, say, dividends from abroad, then they're obviously going to come in as an inflow on our side. All right. Bongeni says he's at work, but he's going to be listening. Okay, that's wonderful. All right. So they are going to be paying some dividends to you if you have invested abroad. So when those monies come in, those are going to be recorded under that. And then likewise, when we make those payments. So I think right below that now we talk about why we normally get this as a negative for most developing countries like our country here. So I think if you observe that, if you just go behind, if you check this out on your spare time, you will see that they are always negative. We are making more payments than we are receiving payments. Why is that so? Because we are actually big on the financial account. So in the sense that we have more investment coming in. We are a developing country. So you don't expect us to be having quite a lot of capital to spare and invest in other countries, but people from developed countries actually do have a lot of capital to bring in and invest in developing countries. So hence, we need to be making those periodic payments to them. So in other words, we make more of those payments like dividends. We are paying more of dividends than we are receiving those dividends there. All right. And then I think right below that, like I said, we are going to be getting an explanation as to why you are going to find such transactions on the current account and not on the financial account. So I'm going to leave you to go through that there. All right. And then, all right below, we also mentioned that South Africa generally experiences a negative balance of net current transfers. All right, what are those current transfers? Right, this item comprises of payments and receipts of government social security payments, taxes, as well as private transfers of income such as gifts, donations, and immigration funds and the like. Current transfers are treated separately from capital transfers. So we are going to see that just now. So when we talk of current transfers, these are just transfers where the giver is not quite expecting anything in return from anything in return for that. So I think it can rightly be described as gifts and donations. So such things that are gifts and donations that are not of capital nature, they have to be classified under the current transfers, right? And then what about capital transfers? So these ones are treated separately from the current transfers. Why? So this account comprises of once off, I think I should have written once off the government grants of capital nature, transfers involving the change in the ownership, acquisition, or disposal of fixed assets, legacies, debt forgiveness, and other items of that nature. So if you look, say we have a debt here in South Africa, I think I forgot to check how big our foreign debt is. So if a portion of that foreign debt is forgiven, right? If a portion of that debt is waived, it's gonna go under the current transfer. And then if a portion of, say, the interest is waived, then that's gonna go under the current account, the current transfer account. That's the difference there. All right, then what about the financial account? What do we expect to find in the financial account? So this one here records mainly the exchange of international asset claims. All right, there is an example there. If a US bank buys a bond issued by the South African government, or a South African company buys or purchases shares in a British company or a foreign company and establishes controlling interest, etc. Any of that. So that's there you can go through. But my interest here is gonna be the main divisions, right? The 4 main subdivisions of the financial account. So again, like we did on the current account, if you're gonna be describing this, then just outline the subdivisions and the kind of things that you expect to find right there. So the first one is direct investments. So what are those direct investments? I think I should have put this one in bold, right? I should have put these terms in bold, sorry. So we have direct investments, portfolio investments, other investments, and financial derivatives, the one that we added there. And then, and then the reserves right there. So when we talk of direct investments, we are basically looking at an investment where the investor is looking to establish control, right? It's where the investor is looking to establish control. So in South Africa, this is defined as at least 10% share of the voting rights in the investment undertaking consent, right? So for big companies, usually once you start owning 10%, you are almost the owner. You have a high degree of control. Why is that so? I think that's the case because you find that because you are dealing with say if you are dealing with a company like Microsoft, you know that you're looking at a company that's worth a lot of money, right? That's worth a lot of money. So if you're going to be owning 10% and the rest of the shareholders are owning 1%, 2%, 0.5%, a couple of shares here and there, you find that your stake, the stake that you control, actually makes you to be in control. When it comes to voting, your vote has a lot of power. You have huge voting rights, you see, because you are going to be weighing 10% against fragmented percentages of ownership. So which means you are in control. You are, you know, one way or the other in control of the organization. All right, so in that respect, direct investment, therefore, we are referring to the movement of such assets, right? The movement of such assets. So here we are not going to be talking about dividends or interest, but we are talking about the assets themselves, the assets and the liabilities. So it's a liability if they are giving us money, right? It's a liability if they are giving us money because at the end of the day, they have invested in us. So hence it's going to be regarded as a liability. So remember that here, the balance of payment, as I indicated earlier, we are looking at the change, the movement in these assets, right? The movement in these assets is what we are interested in. Remember I said this is a flow variable, right? So if you're going to be looking at liabilities, if you look at the value of liabilities as at a certain date, that you can expect to find on the balance sheet. But here on the balance of payments, then we look at the movement, whether there's been an increase or a decrease there. So if you observe that, say, there has been an increase in the liabilities, it simply means more people are investing or more organizations have invested in us, right? So in other words, we've incurred a liability in that regard. So when they're investing in us, which means this is going to be an inflow because they have given us money. So an increase in liabilities is therefore a plus, right? So it's like if you are going to go to the bank to get a loan, that's a liability, right? But at the end of the day, there's an increase in your bank balance. So this is what we are referring to there. So while an increase in your assets simply means that you are purchasing assets abroad, right? So if you are purchasing assets abroad, then it's a minus, right? You are losing money in favor of the people that are abroad there, right? So you will notice that this is working kind of in reverse to what we're talking about in terms of the income receipts and the income payments. So once you get a liability, once you get an increase in a liability, they've invested, they've bought shares in your company, then your responsibility, at least in the short run, would be to be paying them dividends, right? So you get a plus as an increase in your liability, and then the minus is going to be coming periodically through the dividends that you are paying, so which is the income payments that you're going to be making there, right? So if an increase in liabilities means a plus, then it means a decrease in liabilities is going to be a minus, right? So that should mean that you are paying them back the money that they invested, right? That's why that one becomes a decrease, it becomes a minus there. All right, and then with assets again, we said an increase in assets is a payment, right? It's an outflow rather. So which means a decrease in assets is an inflow in this regard. And then what else do we get there? We also have portfolio investments. So the difference between direct investments and portfolio investments is the issue of 10% there. So with portfolio investments, you're looking at usually short-term investments where you don't necessarily have the intention to control an organization. You are merely just purchasing shares, say on the JSE, for hoping that maybe the price is going to change. You are more like gambling on these shares, right? You know, people do that maybe even with companies, right? You can just buy when it's low and then resell when it's high, so you can, you know, do your bets in that regard, gamble in other words. So this is what we are looking at there. So the justification for such investments is based purely on the expectation of financial gain, or the return on investments based primarily on expected interest rates and changes in exchange rate movements. All right, so you are basically looking at the little changes on the value of those shares, right? Which is obviously going to be affected by the exchange, the changes in the exchange rate as well as the interest rate. I think later, or I think that's going to be in ECS 3701, where we talk about how this has an impact on your assets in the stock market, the effect that the exchange rates and the interest rates will have on the value of these markets. So you can basically gamble with this, right? You can basically gamble with this. Say maybe you can expect that the exchange rate, let me just give an example. Say you expect that the exchange rate is gonna, the rand is gonna strengthen, right? You expect that the rand is gonna strengthen at some point. You can maybe gamble and say buy shares when the rand is weak, right? Buy shares when the rand is weak, and these shares are gonna be quoted in South African rands, right? So once you buy those shares when the rand is weak, and say you are purchasing them and you have a US dollar, you are converting those dollars into rands, it basically means that you can purchase a lot of shares, and then you are expecting that the rand is gonna strengthen. So when the rand strengthens, when you sell those shares again, you are gonna be able to make a profit. So this is basically gambling, right? This is basically gambling. So the portfolio investments are notoriously fickle, right? Because changes in expected returns may trigger speculative buying or selling. So there's a lot of speculation anyway there. So these ones are not the same as direct investments. So direct investments, there's a commitment there that we are looking at. We want to buy and keep those shares for the long term. Whereas for the portfolio investments, you just buy for the sake of the short-term benefit, right? When the price is high, you resell. All right, and then we have financial derivatives as well, and these ones are a recent introduction here. So you will find that we don't actually have them we don't really have them there on the example that I put. All right, but financial derivatives have grown to a substantial value and are thus recorded as a separate item, right? Just because they have become increasingly important, so they have decided that now they have to be recorded as a separate item. So it would be nice for you to put this up in an exam, right? But what are derivatives? So since this is not a derivatives module, I think we cover just a little bit of these when we talk about options, when we talk about futures, but derivatives are basically financial securities that have a value that is derived from an underlying asset. So an underlying asset could be anything, right? Could be anything that you consider valuable. It could be gold, right? It could be, maybe it could be wheat. It could even be millies, whatever asset it is. So if you have such a security, then we are basically saying the value of that security is going to be determined by, say, the price of gold at a certain date, right? So that's what derivatives are. All right, so basically the derivative itself is a contract between two or more parties, or more parties, and it derives its price particularly on the spot price of the underlying asset. So if the price of gold at a future date goes up, then it means the derivative price is gonna go up as well. The price of that contract or that security that you guys have exchanged is also gonna go up. All right. So the most common types of derivatives, so these we are gonna look at options, swaps, futures, and forward contracts. So we'll see that just on the next notes that I'm gonna send. So in our next class, we'll probably be talking a lot about that there. All right, so these ones are gonna be recorded only if they involve international transactions, right? Only if they involve. So remember, the introduction here was we're looking at exchanges between South Africa and its trading partners, not between you and me, right? So if we're gonna be exchanging futures or getting into such transactions, forward contracts within the same country, then it's not gonna be recorded here. All right, and then other than that, we would have other investments. So these ones are gonna include financial transactions that are not part of the ones that are listed there. So a good example of there is when you are getting credit, right? Is when you are getting credit. Say you go and purchase things from China, but on credit, but you are granted a short-term credit on that. So it's gonna be recorded under that there. So that one there, you will realize the relationship between what you get there on other investments and the trade balance or the trade account. So in the trade account, we said we are looking at physical merchandise. So if you're gonna get merchandise, say if you're gonna receive merchandise from China, if you're gonna purchase merchandise from China, there it's gonna be recorded there, right? And then on the other hand, if you're gonna be granted credit, if you're gonna be granted credit on that merchandise, that one is gonna have a corresponding entry on that one would actually have a corresponding entry on the other investments there. So they're gonna balance each other off there. All right, so let's see, for example, when a South African importer purchases goods from a foreign supplier, so what happens there? The former will be granted a short-term credit representing an increase in foreign liabilities. That's that there. And then similarly, a foreign purchaser of goods exported by a South African company will normally obtain such a credit, which is going to be an increase in foreign assets. So this one you can also just go through also. All right, and then note that a current account deficit is often associated with a surplus on, it's often gonna be, all right, so most of the time when you have a current account deficit, you will have a surplus on the financial account and vice versa. And that's very common, particularly in developing countries. So we normally have a negative current account balance, but at the end of the day, that's normally compensated by what? By the financial account, which normally goes on a surplus, right? There are reasons for that, of course, right? There are reasons for that, of course, and these ones we are going to be covering quite a lot of again, but it's also helpful to go through that, right? But in brief, if you look, let me see where I can start this off. because I did write the all right, I did write the explanation there. All right, if the imports exceed the exports, there it implies that South Africa is receiving more trade credit than being granted to foreigners, which is reflected as an increase in net other investments there. All right, this is not what I'm looking for, but that's also important. And then interest rates, what happens to interest rates, right? This is what I'm looking for. What happens to interest rates when, okay, so what happens to interest rates when you have a current account deficit? So usually the interest rates are higher there. So that's the response of the, all right, it's usually the response of the central bank, right? Whenever we are having a deficit, it simply means that we are importing a lot more than we should. So to try and tone that down, what do? They put the interest rates high. But at the end of the day, when the interest rates are high, this is going to attract direct investments, right? This is going to attract foreign investments there. So hence, you find that under those circumstances, when you are having a deficit on the current account, we are going to be having a huge inflow, right, on the financial account as a result of these interest rates that are going to be high there. All right, and then reserve assets, changes in the reserve assets, which is basically the official stock of gold and the foreign exchange, reflects the inflow and the outflow of foreign exchange resulting from non-central bank balance of payment transactions over a certain period. So this one you can also go through. And then the unrecorded transactions, because this is supposed to balance in the accounting sense. So there are a number of reasons why this will not balance, right? Because we are dealing with huge accounts. So we are likely to make a mistake there. So when that doesn't balance, in order for that to balance, we balance it off there on the unrecorded transactions. We put an entry on the unrecorded transactions there. So we are assuming that there has been an exchange, maybe that we have skipped. Maybe there are certain figures that we have misstated in these statements. So, but because it has to balance, then we put that as unrecorded transactions there. All right. And then this is also another typical exam question, which I extended, right? Which I actually extended there. I decided to add some notes. So the significance of imbalances in the balance of payments. So the balance of payments, as I already mentioned, that the introduction of the unrecorded transaction simply means that it's always going to balance, right? It's always going to balance. But at the end of the day, the fact that it's balancing, it doesn't mean that we don't have problems. So these deficits and these surpluses bring problems of their own, which are listed there, right? Or which are spoken about there, right? So you can also just go through that there. So I think these I might go through in detail on the shorter videos, right? So this here, the first part, this you can pretty much find, I think, on your study guide, right? You can pretty much find on your study guide. And then on this other side here is an extension, right? Is an extension, the consequences of the current account deficits or surpluses. So on the first part, I talk about what happens, what's the effect of a current account deficit, and then what's the effect of a current account surplus. And then we also look at that there in terms of the financial account, right? So some of the problems that arise as a result of that. All right. So I don't know if we have any questions, but if you do have any questions, I think you can refer the questions either to my inbox or to the group. All right.